Yesterday, we were talking about the latest bear run in the market being prompted by low corporate earnings that have come, disappointing corporate earnings that have come to the fore. But at the same time, we've seen quite a few companies manage to hold on to pretty steady dividend policies. One of those companies being Total Kenya. Do you see many of these companies actually being able to afford this moving down the line?
For most companies, dividends will start coming down a bit. If you notice BAT, which is a counter that normally pays very good dividends, the interim dividend that they actually gave right now gives them a dividend yield of about 2% from a high of 8–9% on full year. So as the impact of the current economic crisis that Kenya is in affects the companies, we expect the dividend yields to start also streaming down going forward. Total will maintain their 2 shillings 50 cents. It has been historic, whether they are doing good or bad, they just keep it at 2 shillings 50 cents.
That, of course, a yield average around 8% off market price. We know that KQ was a favorite for investors all through last week as we head towards the dividend book closure on the 25th of September. And that counter, many saying, may experience increased activity ahead of that closure of the book. Divi aside, though, I mean, what is the investment merit when it comes to Kenya Airways right now?
The Kenya Airways right now, they're trying to expand their market regionally, as in the continent. Because the tourist arrivals in the country have not been that good, and it has hurt them very much, considering most of their business was actually from Europe, European destinations and markets like that. So now we see them on a drive to try and get the African market, which is actually a bit more competitive because of nearly each country has a national carrier, which they like to promote first before any other carrier. So in terms of the company prospects going forward, they don't look that bright.
Well, other companies recording quite a bit of activity in the banking space was Cooperative Bank. It's a locally traded counter, and local institutions have been supported off the price. What's the investment merit there in your books?
Cooperative Bank, good market basically, but I just have a few issues on the expense line, which is a bit more suppressed. Especially with the expansion plans that they have, we expect to see their salary line going up, as in the staff expense going up. As much as they claim that they will recycle staff, we still expect that they have to start hiring more staff, or if actually not paying better the staff that are currently there. So it is a good counter in terms of fundamentals and going forward. And the nice thing about the counter is that it has local activity on it. And as long as it is local activity, at least you'll be able to buy and sell out of the counter. We
have a report recently saying that they expect more tempered growth forecasts for the second half for banks in general. They see it coming in, flat to slightly higher. And based on that some of the shares in the banking sector over in Kenya look overvalued at this stage of the game. Are any looking overpriced in your books right now?
If you look at the banking sector and the reason why they actually recorded not so good results in the first half, most of those fundamentals have actually not changed. And with most banks moving away from giving out loans to the public and giving loans to the government, basically through treasury bonds and treasury bills, I don't expect their revenue lines to grow that much. So the aspect of that, them being overpriced, is actually a bit true, and they are the main sector that will actually drive this bear run even further to the end of the year.
Well, the CBK has certainly paid a lot of attention to interest rates being charged by Kenya's banks. I mean, we've heard the central bank governors saying that the lowering of rates in tandem with the central bank's own cutting is critical to macroeconomic growth. Are we seeing banks actually lowering their rates at all at the required pace?
Not actually. Banks have never responded to the central bank. He has tried threatening the banks. He has tried to force. He has tried to use propaganda. He has tried to use market statistics to just show which banks are offering loans at a cheaper rate to see if banks will actually bring it down. But if you do a survey of the banks, the lending rate actually is around 19.75 going forward. Standard dropped to 16%, but it's only an offer. which is ending, I think, at the end of this month or the middle of next month, then they go back to the 19%. If you look at the issues on the ground, there's nothing that actually justifies banks to actually reduce in tandem with the central bank rate.
Well, now in this instance, we've got banks trying to bolster earnings. At the same time, though, we've got banks needing to consider the prospect of non-performing loans if they don't start moving in tandem with the central bank's lowering of rates. Is this becoming more of a risk in your books, or pretty well managed at this stage?
There's a lot of liquidity. The government wants to borrow a lot to cover their deficit and the food that they have to import, the energy they have to import, the sugar they have to import, and all the other things that the government has to import right now. So currently they have a home for their funds. And as long as the government wants to borrow, they can still get a 10% here, a 5% here. But considering these funds are free funds, the deposit rate in Kenya is currently at around 3%, 4%. So if they get it at 3% and they put the money at 11%, 12% in a bond or a treasury bill, they'll still be able to make their margin.